Hi there, welcome to Napier Invest. Time for a bit of an update to Megaport. This company was a bit of a cult stock on the ASX for a period of time, might even still be a bit of a cult stock. And in fact, I remember listening to a podcast, so it would have been probably January 2022. And in this podcast, might have been Livewire, a group of fund managers, Australian fund managers, were asked which company they thought was going to outperform the market during 2022. And Megaport was the most popular pick. And it was not a good year for Megaport. And hopefully you didn't listen to this particular podcast and take a position in Megaport just because it was the most popular pick. Now, because Megaport is not profitable and they are like a tech company, they have been sold off. And the market has been disappointed by the financial performance of this company over the past year. And whenever the company does release an Appendix 4C, so we're talking about January, April, July, or October, we have seen share price decrease a lot by, say, 20 to 25% in one day on the back of a disappointing Appendix 4C. And in one instance last year, the share price actually rallied 23% because the market thought maybe the company is starting to turn things around. So I thought it's a good idea to have a bit of an update at Megaport because not only have a look at their financial status, have they improved their cash flow? Are they getting close to profitability? They've also released an announcement the other day in regards to an executive change. And the CEO, or the ex-CEO, Vincent English, has resigned. And now the interim CEO is Bevan Slattery, who is the founder of the company. So just a few facts in regards to Megaport, simple facts. So founded in 2013 by Bevan Slattery, and he's now the interim CEO. Not sure how long this is going to take, probably a worldwide search. And Megaport was listed on the ASX in December 2015. So we're talking about a 7-year history as a listed company, and it has been unprofitable over that period of time, but it's seen its revenue and its cash receipts grow quite impressively over that period of time. And before we've seen this weakness in the tech sector, this type of company that can grow their revenue at a really impressive rate was really liked by the market. That's why the valuation of this company got as high as 3.2 billion. In fact, it was even higher than that because this was only a point in time in November 2021. And at one point, I think the share price got as high as $22 or $23. So around about $3.5 billion markup at the height in the love affair of Megaport. Right now, the share price is $4.43. So the share price has fallen a lot from its highs, and that's only taken about 18 months. And at $4.43, the markup of this company is $702 million. Now, I would think that some investors would think that's pretty good value for this company that had a markup of $3.2 billion not that long ago. But again, this company is not profitable. They are growing their revenue. They're decreasing their operating cash flow and free cash outflow, but it doesn't mean they will ever get to profitability. So that's what the market wants to see from this company, any sign of a path to profitability. And the T code for Megaport is MP1. So let's have a look at the half-year results. And I'm just going to concentrate on the statement of cash flows in this slide. And we'll also have a look at the profit and loss statement in the next slide. So sometimes when I do look at the update of a company, particularly if I'm focusing on Appendix 4C, the statement of cash flows is spread out over about 3 to 4 pages. But when you look at the financial statements, when a company releases a half-year, full-year results, typically the statement of cash flows is on one page. So you can see the cash flows from operating activities, investing activities, and financing activities on the one page. So in some ways, I do prefer the half-year or full-year results when it comes to statement of cash flow. So the main thing we're looking for here is not really the receipts growth, because I'm looking at when we do look at Appendix 4Cs because we have no revenue. So cash receipts is the main focus, and operating cash flow and free cash flow is the main thing I'm looking for when it comes to Appendix 4Cs or 5Bs. But when you look at the half-year or full-year results, you can also see the revenue in the profit and loss statement. But the main thing I'm looking for here is operating cash flow and also free cash flow. And free cash flow is very important for Megaport because they do spend a lot of money on capital expenditure, which is payments for property, plant, and equipment. They also spend money on payments for intangible assets. I'm assuming that is IP, and that is capitalized research and development, which does affect amortization. So even though this company, Megaport, was operating cash flow positive by $860,000 in the first half of financial year 23, they did spend $7.3 million in capital expenditure and $5.5 million on the payments of intangible assets. So in investing activities, they burned through $12.8 million of cash. So this company was free cash flow negative by a significant amount. We're talking about $12 million. So this company is still burning through a lot of cash. And even in the financing activities, they burn through a lot of cash. For instance, payment of principal portion of lease liabilities. So they rent out offices, that sort of thing. Not only offices, also probably where they have all their stuff, wonderful stuff they have. Interest and other costs of finance paid, $764,000. Repayments of borrowings, if you take away the proceeds of borrowings, they decrease their debt by about $1 million. So overall, this company burned through about $17.7 million of cash in the first half of financial year 23. And cash on hand is down below $40 million. And at one point in time, not that long ago, the cash on hand for this company was over $100 million. So another reason why we might see a little bit of negativity in the market around Megaport is just a possibility, you might even say probability, that this company will have to do another capital raise within the next few years if they don't achieve free cash flow positiveness. And if we have a look at the profit and loss statement, so even though this company was operating cash flow positive, and that is a first really important step I do look for most companies, then I look at free cash flow, or whether a company is free cash flow, then also compare it to the profit. So Megaport's revenue for this half year was $47 million, a nice growth from last year. So last year, the revenue in the first half was $37 million. So this company is still growing their revenue, which is a good thing, but costs are still going up, not quite as quick as revenue. And we want to see revenue for this company significantly increase at a greater rate than their spending. They haven't quite achieved that point yet, that scale yet. So in the first half of financial year 23, this company had a loss of around about $10 million. In fact, the total comprehensive loss for the period was $12.2 million. That takes into account exchange rates. If you don't take into account exchange rates, their loss for the period was $9.2 million. Not as bad as last year, which was $14.6 million. But again, this is 1 half year. So over a 4 year, there is potential this company will be loss-making company by about $20 million. When I quickly went through Megaport's half-yearly presentation, it was not surprising. They seem to concentrate on EBITDA. And EBITDA is earnings before interest, taxation, depreciation, amortization. And depreciation and amortization, especially amortization, because they do capitalize research and development, is quite high for this company. In fact, I didn't mention it in the profit and loss statement. So let's go back here. So depreciation and amortization expense was $12.9 million in the first half of financial year 23, almost $10 million 1 year ago. So this company has a lot of depreciation and amortization because they do capitalize research and development. They also have a lot of capital expenditure, which is the depreciation. So it's no surprise this company is focusing on EBITDA because they are loss-making company by about $10 million. And the reason they're concentrating on EBITDA again, or for another reason, is because they're positive EBITDA. So they've mentioned here scale up, scale out. So up until about 3 quarters ago, this company was EBITDA negative. Now they are EBITDA positive. So it's a step in the right direction. But again, don't be fooled by a company that is focusing on some positives. And Megaport have definitely done that by focusing on their EBITDA. I still would like to see this company profitable and also free cash flow positive. If I see this company heading towards that direction, that's when I would become interested in this company. Now, it wasn't that long ago that the market was only interested about revenue growth. That's all they cared about. They didn't care whether a company was profitable or non-profitable. It's all about how fast you can grow your revenue. And to be honest with you, revenue growth is really important. It's probably one of the most important things you can have as a company, because if you can't grow your revenue, you really can't grow your profits over a long period of time, because the only way you can grow your profit if you can't grow your revenue is by decreasing your costs or by increasing your margins. And both of those things are only finite things. So you can only increase your margins by so much. you can only decrease your cost by so much, but you can increase your revenue infinitely, to $2 trillion a year or something like that, crazy like that. So that's why I'm really interested in companies that can grow their revenue really consistently over time. And this is the receipts history taken from the Appendix 4Cs from Megaport ever since they listed on the ASX way back in 2015. And back then they had receipts of $540,000 in a quarter. So they have grown their receipts from $540,000 in a quarter to as high as $31.6 million. And that was 2 or 3 quarters ago. So nice growth, nice consistent growth in receipts. Now, receipts don't always go up in a straight line. There have been some quarters here where receipts have fallen back. We have seen that happen quite a few times in the past. But typically, when Megaport sees one quarter of receipts go backwards, the next quarter is a jump. They see a jump up in receipts. But that has not happened in the most recent quarter. So we have now seen 2 quarters of decrease in cash receipts for Megaport. In fact, Megaport's receipts have dropped from 31.6 million to 23.6 million. Now, this does not necessarily mean that there is a problem for Megaport. And I would now probably surmise that the next quarter, the current quarter we're in, their receipts will be significantly higher than 23.6 million. But the market is taking notice to this. And in fact, the last 2 quarters, we have seen the share price drop by over 20% on the back of disappointing receipts. And the quarter where they did see the share price rise 23% was that record quarter, that June quarter, where receipts was $31.6 million. So the market is looking at receipts, and there is that potential. And I am just assuming here that the next quarter will be a good quarter in terms of receipts for Megaport. I think you might see a pretty good share price and market response when they do release their Appendix 4C, which will be in April. So only, 1 month away until we see Megaport's next quarter results. But again, if you've been listening to what I've been saying, the share price has fallen a lot over the past about 18 months. In fact, November to now, that's 11 March. So that's about 16 months the share price has fallen. Share price did reach a high of about $22. So I thought it might have been $23, but it was $22 in November 2021. And during 2022 into January 2023, we saw some really big down days for Megaport. In fact, there was about 4 big down days and 1 big up day. The 4 big down days was in January 2022, share price down 16%. That was sort of the catalyst for a shift in sentiment of this company. You can see the share price fell a lot. Share price was still a bit of an uptrend. And then in January of 2022, share price fell down. And that was sort of the signal to get out if you're trading this company. And the share price just kept on falling. And then the share price fell 22% in April, another disappointing Appendix 4C. It rose 23% in July. But you can see right here is where they released their Appendix 4C in July. But the share price was rallying into the moving averages, which is not a good thing. And eventually we were going to see a bit of pressure on the share price. And that's exactly what we saw after that initial rally, after Appendix 4C in July. Share price started to fall after that. And then they released their Appendix 4C in October. Share price fell 22%. And then when they released the December quarter, share price fell 25%. So the market absolutely hated that particular quarter results. But the share price had not at that point in time got to the lows we saw back in June. Those lows were just under $5. Now, these 2 dashed lines I've got here, the top dashed line is the COVID-19 lows. So right now, the share price is not only below the COVID-19 lows, it's also below the June lows, when the share price did bounce off a nice little support level at those June lows. And the share price recently has struggled to bounce off that nice little support level. In fact, the share price now is below that support level. And that support level was sort of initiated or began way back in 2015-16. So we're now seeing a share price get to lows we haven't seen for about 6 years with Megaport. So let's have a look at the weekly chart just to see where the share price is now compared to the last 8 or so years. When did they list again? 2015. Yeah, the last 8 or so years. So this is the weekly chart for Megaport. It doesn't go that far back. In fact, 2018, I was a little bit wrong. I thought it was that support level was about 2 years previous to this. So this particular weekly chart goes back to 2018. And in 2018 and into the start of 2019, share price was going sideways and it was really struggling getting above about $4.60 or so. And finally, in about April 2019, share price went above that support level. And that was a breakout in the share price of Megaport, and the share price just kept on going up. So technicals do work, and I get a little bit upset when I hear people say, particularly experts say, technicals is just, reading tea leaves, that sort of thing. And I have seen proof upon proof that technicals do work. And here's another bit of proof. When the share price broke out in the Megaport in April 2019, share price kept on going up. In fact, if you bought into this breakout at around about, say, $5 and held all the way up to where the share price started in its downtrend, say around about $15 or so, maybe a little bit more than that, this would have been a triple bag for you. But usually when a share price does fall a lot like Megaport, it falls much quicker than when the share price rises. This is not only true for companies, this is typically true for the market as well. And we have seen the share price fall fairly quickly for Megaport, and now it's fallen below that old resistance level back in 2018-19, became support. The support held firm in June of last year, and now it's been broken. I'd like a little bit of confirmation that this support level has been broken, but there is potential. There's more to fall for Megaport right now in terms of the share price. But I'm going to be really interested to see the April quarter report, because if what I'm thinking might happen, that it surprises to the upside, I think maybe the lows will be soon. That's all I have for this Megaport update. Probably should mention that I am not a Megaport shareholder. I was a Megaport shareholder for a very brief period of time after the company released their impressive June quarter results. The market was impressed as well. Share price rose 23%. And my thesis behind that particular trade was I thought there was potential. That was the inflection point for Megaport. It hasn't come to fruition. And because my thesis was broken, I sold my shares in Megaport. And I'm still waiting for that very important inflection point, because I believe, this is just my opinion, the best time to own a company is when it transitions from a low-quality company to a high-quality company. I definitely would not call Megaport a high-quality company simply because it is not profitable. It is burning through cash. Doesn't mean this company will ever become a high-quality company, but if it does, that's when you want to be holding some shares in this company, when it makes that transition from a low-quality company to a high-quality company. And I think there is potential this company will do it at some point in the future. I don't know when. Probably no one knows when. Some people who believe that will happen will take position in this company for the long term. They just don't want to risk it that maybe it happens tomorrow. I'm willing to wait a little bit longer. I'm willing to take that position after I see proof that they are transitioning to that higher quality status you want to see for a company, for any company that's in your portfolio for the long term. Anyway, rambling on a bit. So if you have any questions about Megaport, any thoughts about this company, I'd love to hear them. So leave them in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.